They did say they're going to create price floors, but I don't know, I haven't seen anything legitimate that says there is a established $1,000 price floor. When you see a market in continued backwardation that is normally never in backwardation, it's normally in contango, where the current price is less than the futures price. The futures price takes into account interest, storage, the cost of money. But for a long period of time, it continues to trade in backwardation, meaning we want it now. We don't trust the future. We don't trust the exchange. We don't trust any of it. We want it now. When we see repatriation from the central banks, from the Bank of England, the New York Fed, that means we don't trust the system. And when you see in the month of February, roughly 15 million ounces more delivered off of COMEX than was delivered into the exchange, or should I say leaving COMEX than was delivered into COMEX.
You mentioned squeeze. Squeeze that looks toward price. So have we been in a squeeze? Yeah, absolutely. The price is going higher. But the danger is that there's more delivery demands than there are ounces in inventory to deliver.
In a market shaped by tightening liquidity and rising systemic pressure, the conversation around physical metal delivery is shifting from a distant concern to an urgent one. Especially in silver, visible imbalances and widening gaps between paper claims and physical availability underscore stress in delivery patterns and vault movements. Building on these visible stresses, Andy Schectman, a well-known voice in the bullion space, and Bill Holter, a longtime macro commentator, explain how the system is approaching a critical inflection point. They highlight that recent delivery behavior signals tightening supply conditions, with large entities increasingly opting for physical settlement rather than rolling contracts forward. Continuing demand for physical delivery could redefine the silver market. Availability, rather than price, is poised to become the decisive factor moving forward. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
I would simply say that yes, this is true, especially when no one ever stands for delivery. But the amount of delivery that we see is making naked shorting a very, very dangerous game and continues to play into the hands of those that are standing for delivery. And I think that that's really the crux here. What is changing the landscape of the metals market, in my mind, is a system that has lost its integrity and a system that no longer carries the kind of trust that it needs to have to be the global benchmark. When you see a market in continued backwardation that is normally never in backwardation, it's normally in contango, where the current price is less than the futures price. The futures price takes into account interest, storage, the cost of money. But for a long period of time, it continues to trade in backwardation, meaning we want it now. We don't trust the future. We don't trust the exchange. We don't trust any of it. We want it now. When we see repatriation from the central banks, from the Bank of England, the New York Fed, that means we don't trust the system. And when you see in the month of February, roughly 15 million ounces more delivered off of COMEX than was delivered into the exchange, or should I say leaving COMEX than was delivered into COMEX. In other words, 15 million more ounces left the building than deliveries can explain. You begin to understand a trend, and that is a trend of erosion of confidence and trust in the paper market, continuing to short that market when there are very well-heeled and sophisticated traders, from central banks to sovereign wealth funds, standing for delivery, where price misdirects most people and most institutions, but not these folks. It's a dangerous game, and it's one that won't end well, in my opinion. You're beginning to see that. Now, I would simply say, if I had to guess, the folks that are standing for delivery are far more sophisticated than they are emotional. And the emotion is, well, you know, they continue to be able to do this. How can they continue to do it? How can they continue to suppress the price? They'll do it indefinitely, but they won't, because the demand for delivery continues to outpace expectations, continues to outpace any precedent. And so this is the little by little by little, and that's the part people have a hard time with. You know, this entire era of instant gratification and it not being fast enough, I think, is being attacked methodically. and in a very regimented way where they will continue to slowly bleed dry the exchanges at a manner that doesn't stop everything in its tracks by just throwing all the money and say, no, we want delivery. They will play the game until the game is no longer able to be played. So I don't know. I just think that Rick is right from a standpoint of recency and normalcy bias. But if indeed these deliveries continue the way that they have, these games will end up being an existential threat to those that are silly enough to suppress the paper price to that degree. But they did say they're going to create price floors. But I don't know, I haven't seen anything legitimate that says there is a established $1,000 price floor. Yeah, I mean, exactly. That's exactly what it is. And because you're preparing in a way that is counterintuitive to conventional thought, conventional investing, and, you're putting your eggs on that side of the table. Well, if things don't play out the way that logic would dictate or you anticipate, sure, there's an opportunity cost in everything that we do. And that's the hard part for people to get. That's why it's easy for, financial advisors to say, well, then again, you're making the wrong decision, sir. This is what you want to do. You can only manipulate a market for so long by pushing it in the direction that it is going. When you have the world moving in the other direction, you end up doing something very risky. When everyone is clamoring for physical possession and you have unlimited paper promises that have the ability to stand for delivery, at some point you've outplayed your hand, and there will be entities that will stand for delivery with unlimited funds just like you and that will challenge you. That's really what we see happening for the first time ever. We're seeing the Western markets and the hegemony associated with them be challenged simply through rules that they employed themselves. Now, in an effort to mitigate said rules, 4 times in 2 months, we see markets that glitched, right? Twice to the up, twice to the down. When they fell both times, well, sorry, the circuit breakers broke. We apologize. Don't do anything about it. We just let it collapse. And on the way up, oh, sorry, it overheated, and we didn't even figure out what the last one was, where the market was halted. Trading was halted. In both cases, they got slammed. And then in both cases, well, we haven't seen what will happen here. But last time this happened, silver went up 120% in 60 days. So we'll see if that happens again here. But what you are witnessing to me is the realization by some very big money traders that they have these Western entities that are playing this game kind of trapped in the respect that let them keep playing their game, we'll keep standing for delivery. And you can see that in the ever increasing delivery numbers. Someone or someones are saying, fine, go ahead, knock it down. We will continue to stand for delivery. And that plays right into the hands of those that look at the dollar price as one that is certainly valued, I think, less than the dollars used to buy it, or more than the dollars used to buy it, rather. They don't care what the dollar price is. They're continuing to stand for delivery. And when you see the outflows out of COMEX outpacing the deliveries into COMEX, that's about as rare of a bird as it gets. So you're beginning to see the other side of the coin quietly playing their hand right into, I think, using the manipulation of the Western banks to their advantage. So it's not going to last forever. It's frustrating that it continues to last, but these are desperate acts by desperate entities who are playing by rules that are beginning to become obsolete, in my opinion.
What stands out is the strain within the delivery mechanism. The system has relied on confidence that contracts can be settled or rolled without widespread physical movement, but growing physical demands are exposing its limits. Silver inventories are being quietly drawn down, while demand, particularly from large players, remains persistent. This imbalance creates pressure that doesn't immediately show up in price, but instead builds beneath the surface. The longer this continues, the more fragile the system becomes. There is also an implied shift in behavior. Instead of treating silver as a speculative asset, certain participants are positioning for ownership. This distinction signals a move away from paper leverage toward tangible control, a pattern that historically precedes more volatile phases of price discovery. Let's get back to the interview.
You're asking me about the markets today, gold and silver, and they are markets plural. When I say plural, I'm talking about the paper market and the physical market. The paper markets are becoming irrelevant, if you will. I mean, you've got $75 silver in New York, in London, yet you've got $80+ silver in Shanghai, higher in Japan, higher in UAE, Dubai, all over the world. The physical market is trading above the cash market. I'm sorry, above the futures market, the paper markets. When a spot price trades above the futures price, it's called backwardation. That should never happen, because how could an ounce of gold be valued today less in the future than it is today? It can't be, because there has to be some time value of money. So that's a very rare occurrence. But what you're having happen now is you've got backwardation between markets themselves. The cash markets are trading above the futures markets, the paper markets, and that's people, investors, buyers. This is not about stackers. Silver, the big demand is coming from industrial use. But the point I'm trying to make is you have the paper markets and the physical markets separating. If you want to call that backwardation, you can call it backwardation. But what it tells me is that the paper markets in short order are going to become irrelevant. I would ask you to go back and remember what happened in April of 2023 when those 3 banks in California went down on a Thursday or Friday. I was on a short trip, turned out really not to be a trip, because the phone started blowing up. People were scrambling to buy metal. And by Monday morning, no dealers had any metal left in stock. And I mean, we were taking orders with the promise to deliver in 6 weeks. So what I'm getting at is this can happen very quickly. And I'm on the record that this will end up as a failure to deliver. And I believe that will begin, or that will happen first in silver. It'll be followed by gold probably within 24 hours. You mentioned squeeze. Squeeze that looks toward price. So have we been in a squeeze? Yeah, absolutely. The price is going higher. But the danger is that there's more delivery demands than there are ounces in inventory to deliver. And that failure to deliver, COMEX will issue force majeure. They'll pay people in cash. That way they can say, no, we didn't default. But make no mistake, it is a default. If you bought a silver contract with the expectation that you could stand for delivery, get the metal, and you don't get the metal, that's a default. From a technical standpoint, they can legally say it's not a default, but in the real world, that's a default if you don't get your metal. You're not going to be able to alter your position. You won't be able to buy gold. You won't be able to buy silver. If you don't have it, you're locked out. Everybody's worried about price. Forget about price. The bottom line is, do you own it or do you not? How many ounces do you have? You're going to count your net worth in the future in ounces, not dollars, not yen, not euros. You're going to count your net worth in ounces. So price does not matter, because silver is going to go through a failure to deliver. And when that happens, you either own silver and have it, or you don't. You're either in or you're out. And if you're out, you'll never be able to get back in. You'll never be able to get in. There won't be physical metal for you to buy with fiat. Fiat is not going to be accepted for physical metal. So don't worry about price. Just get capital out of the system into metal. Metal can't bankrupt. The system is bankrupting. Yeah, I think at 55-56 ratio, I think we're in no man's land. When we were in the 70s, 80s, up to 120, I mean, that was a no-brainer. You buy silver, and at a later date, you sell some silver and swap back the gold, and you'll get more ounces than what you would have had you bought the gold outright to begin with. So as the ratio comes down, I've said that I think people need to move in tranches. If you're looking to move X amount of dollars or X amount of percentage of your portfolio, I would do a quarter at 50, a quarter at 40, a quarter at 30 to 1, and then the last quarter you do as just a gut feel trade. You're not going to be able to pick the bottom, but if you do it in tranches, you can't be wrong and you can't be right, but you'll be better. You'll end up with more gold ounces than you would have if you didn't do that.
As these pressures build, the broader implication becomes harder to dismiss. A system built on leverage and paper promises can function smoothly until it can't. The transcript suggests that silver may be approaching a threshold where physical demand begins to challenge the market structure. If delivery requests keep rising as inventories tighten, prices could shift rapidly and sharply, suddenly reflecting scarcity rather than adjusting gradually. These price moves are nonlinear, typically sharp, reactive, and hard to control. Echoing this outlook, the discussion also suggests that larger entities are preparing for that shift. Their behavior reflects accumulation rather than speculation, suggesting that they anticipate a different pricing environment in the future. If accurate, this positioning could act as an early signal of a broader transition. Ultimately, the message is not about short-term volatility, but structural change. All these conditions described point toward a market where access to physical metal becomes increasingly important, a consistent theme throughout the discussion. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.